Let's start at 70 and a half. It used to be a key age because that was the deemed required minimum distribution age, not anymore. Now there's something else that we focus 70 and a half on, Heather, so talk to us about that.
Yeah, so back in the day when RMDs began at 70 and a half, that was when qualified charitable distributions began. And believe it or not, I think they've been around since, like, don't quote me the year, I think it was like 2016. They have actually been around. And in fact, they were supposed to expire and then they got extended. And then they would expire and then they got extended until finally they were made permanent. Qualified charitable distributions are the best thing since sliced bread that
Amen.
Anyone who has an IRA that is charitably inclined. So think of yourself, if you are routinely tithing at your church or you're donating to some charitable cause at 70 and a half, if you have an IRA, you should consider pivoting and using the QCD strategy because it allows you to contribute up to $100,000 a year. It is indexed this year. I think it's $105,000 from your IRA. So if you're married and you both have IRAs, you can each do it. You have to move the money directly from your IRA to the qualified charity. So some custodians will directly send it to the charity. Some will make the check payable to the charity that you told them to make it to and send the check to you. And then it's your responsibility to get it to the charity and get the proper receipt. But the beauty of it is you can do is, again, up to the $100,000, $105,000, and then it is tax-free. So you might know that hardly anyone is itemizing anymore because the standard deductions under the tax cuts, the ones that are getting ready to expire, like Brad says that were on sale until the end of 2025.
Right.
No one's really itemizing. Very few people. I think it's 5% of taxpayers, and so that means that hardly anyone's getting to take advantage of their charitable donations. And so this is a way to, without itemizing, being able to take advantage of a tax-free situation. So you take a qualified charitable distribution, it's not only not, you don't have to deduct it, it's tax-free and it goes to the charity. So you're taking advantage of something that you otherwise wouldn't be able to take advantage of if you're not itemizing your deductions. Fast forward to the point at which you get to RMD age, and now it's a double whammy because now not only is it tax-free, but it also can satisfy all or a portion of your RMD. That's huge. So this is a huge way. Go back to where I was talking about if you have RMDs that are going to push you up into a higher tax bracket, push you up into Medicare surcharge territory, this is the first thing you should do to bump your AGI back down. So if you have large RMDs, you are routinely donating to charity, pivot to this QCD strategy because not only can you satisfy, I said, all or a portion. If you have $150,000 RMD, well, you know that you can do $100,000 of it to offset the RMD. $50,000 you would still have to take to get rid of $100,000 of your taxable income. It's a huge opportunity. I tell every financial professional that I work with, hey, make sure that starting, at 70, you're reminding clients about this so they can start doing it at 70 and a half. When they can get to the age at which they're subject to RMDs, it's only from IRAs at this point. We thought it might switch to be available to 401ks and other qualified plans. It's still not, but it's a huge tool to use.
Well, let's do this. Let's blend the age 70 and a half and 72 and 73 kind of together because this is flowing really well. And again, we're about to run out of time. So here's the thing. Yeah, I know it's so confusing. The first RMD age that we knew forever was 70 and a half. Then for a short period of time, it moved down to 72.
72.
And
right.
Now it's at 73. But here's where the RMD and the QCD blend together beautifully, like Heather was saying. I cannot believe that financial professionals don't talk to their clients about qualified charitable distributions. When you think about it, you get to take a tax deduction on the front end when you put the money into the retirement plan. Then you get to take it back out and give it to your church or your charity on the back end and leave Uncle Sam on the bench completely when you do it the right way. You got to get over the old school thinking of, well, I need to write a check and see everyone watch me put it in the plate. And, and anymore, it's not that way anyway. We all give on our phones and that sort of thing. But there's a much better way to do it. If you've reached age 70 and a half and you're working with a qualified financial professional and a willing custodian, it has to be a willing custodian. They have to be willing to cut the check directly to the custodian, to your charity of choice, and be able to do that. Now, we do that for all of our clients. You tell us what QCD you want to take. We will work with the custodian to get the check made to the charity. most of the cases it's got to go to you and you have to deliver it, but you are finding a way to give that money and never have a taxable event take place. But here's the key thing, and I know Heather can talk about this. You got to be very careful once you hit age 73, which is our next age, now the required minimum distribution. Don't get trapped in your mind into thinking, well, my RMD for this year is $5,000. So I'm going to take that right off the bat in January. And then later in the year, I'm going to do my QCD. You can't do that.
You can't undo it, right?
The first dollars out of an IRA are deemed the RMD. So I tell everyone, if you're going to use a QCD, do it at the beginning of the year and make sure you make that gift, because that QCD will satisfy the RMD, but you can't reverse it. You can't take the RMD first and then give a QCD later. It will be taxable because you've already done the RMD. Is that correct, Heather?
That's right. You can't undo it and say, oopsie, I meant that $5,000 to count toward a QCD. You can't undo that. So you always want to make sure, because a lot of people have their RMD set on auto pay, right? So you want to undo that in a year that you want to do a QCD to make sure that you do the QCD. You stop the auto payment of an RMD because the auto payment is going to come to you. So make sure that you do that and I think most custodians, they can't deny a QCD as far as I know. Make sure too that when you do your taxes, if you have a tax preparer, make sure that you tell them that you did a QCD, because there's a certain way to there's instructions. It's not hard, but there's instructions on how to properly account for the fact that you did a QCD on your tax return. But yeah, like Brad said, it is a game changer to me for anyone who's trying to lower their tax liability once they reach that 70 and a half age. And then once they reach, 73. So yeah, we had, a year and a half or so of having 72 as the RMD age. And then the Secure 2.0, increase it to 73 for people born between 1951 and 59. And then those born in 1960 or later can further push it out to age 75. Is that a good thing? That's a nod to people who are living longer. For some, it can be good. But again, the longer you wait, the higher balances are going to be, the bigger the RMDs are going to be. So you really have to work with someone that can help you figure out, is that a good plan? Or is it better to perhaps live earlier on your pre-tax qualified plan balances and perhaps hold out on Social Security or something like that? You really just have to look at what makes most sense for you. So, I think we hit them all.
That's it. And if you missed that, that's what she was saying. If you're born in 1960 or later, even though the age is 73 for RMDs now, it's already been deemed that it's going to be age 75 if you're born in 1960 or later. So
by the time our kids are that age, they'll be 85. Who knows?
It will be, because here's what Ed Slott always says, our good friend and our mentor. You can be certain of one thing. Anytime Congress meets, there will be changes.
That's right.
And that's why you want to tune into a show like this, to hear experts like Heather Schreiber, because we're constantly staying on top of all the things that you need to know, key dates, key ages regarding your retirement planning. So